I would not be able to see any of you, and I don't know how the reaction would be. So usually when I used to do presentations, I could at least get some reaction on whether you all are understanding. So it's going to be a little challenging, but I would really encourage everybody to stop me if you've got any questions or any doubts. Please do stop me and ask me. I would be really happy to answer those. As Mr. Abhishek said, we have never learned about investments when we were in a college or in school. We actually get to know about investments only when we start earning or when we start seeing some cash flows into our account. So that's where I come into the picture and help individuals manage their portfolio. Thank you, Mr. Abhishek. I'll just share you my screen. Just let me know when you can see it.
Sure.
Please let me know.
You can see it.
Perfect. Great. So warm welcome to everybody to our Money Talks workshop. As I said earlier, I want the session to be interactive, and I want you all to ask me questions or anything to do with investment planning. So what are we going to do today is basically, I'll talk to you about our company, about PeakAlpha. Then I'll talk to you about what financial planning is and why is it important. Then I'll talk to you about tax planning. This is a little important part because a lot of us do tax planning without actually knowing where your investments are going on, how do you save your taxes. Then I'll talk to you about risk management. That's during the pandemic, this has hit us pretty hard. So I'm going to talk to you more about the risk management part. Then I'm going to talk to you about wealth creation, which is the more exciting part, and how do you basically try to increase your savings and try to invest into different asset classes. Then I will talk to you about the importance of asset allocation. And then I'll talk to you about power of compounding. That's a very interesting slide. Since you all are young and there's a lot of you'll be able to see the power of compounding. Is that fine?
Yeah, perfect. Please go ahead.
So about PeakAlpha.
Hi, Subra, Neha, we are getting some backend noise from your end. Request if you could please be on mute. Thanks. Please proceed, Ajit.
So about PeakAlpha. PeakAlpha started in June 2005. So there is a small story behind how PeakAlpha started. So our managing director and his wife, Ms. Priya Sundar, who is a director of a company, came back to India from US, and they wanted to invest into the Indian market, and they wanted to get a professional advice on how do you basically do your investments. So they were approached by a bank. I don't want to use the name of the bank, but they were approached by a bank, and the bank, after 1.5 hour of discussion, came up and said, you invest into this ULIP. And that was utterly wrong. That was a sin. The kind of advice which was given by the bank, which was one of the leading banks, was completely wrong. And that's when our managing director and our director, his wife, Ms. Priya Sundar, said that there is some kind of lapse or some kind of not the right method of educating and helping people with their finances. And that's where PeakAlpha came into being. I'm very proud to say that PeakAlpha is an ethical company, and we follow our ethics pretty strongly and help individuals and families to maintain a cash flow over a period of time, and especially when it's required the most, that's after your retirement. So we at PeakAlpha do a lot of cash flow management, understand people and help them with their investments. We have currently over 4,000 customers and across 80 companies and more. And actually, we have done presentations in companies in Bangalore, Chennai, and we're Hyderabad and few other cities. But if you look at our customer base, it's all over the world. And during the pandemic, we have also learned one thing: you just require a network connection and a laptop to give an advice. And so that's about PeakAlpha. And we are SEBI registered investment advisors, where we get audited by SEBI whatever advice what we give. So before we give an advice, we also send you out a report. In that report, we tell you why you're required to invest here, what is the basic knowledge. So it's a complete transparent way of looking at how you manage your investments. PeakAlpha has been very lucky, or PeakAlpha has been awarded quite a lot of awards by. We've been the best performing individual financial advisor, and this was in 2015. Then it was again in 2017, and again in 2018. And this was given by UTS ENBC. So that's one of a award what we have got. And we have been, so since we have got for 2015, 2017, and 2018, in 2020, they said that we'll put you on Hall of Fame so that they give an opportunity to other advisors to get the award. So we've been a frontline leader in advice and how we manage our portfolios. Okay, now this is the crux, or this is the main part of the presentation. I want you all to pay attention or just follow me through the next few slides, and please do stop me or please do raise your hand if you've got any questions. Can you all see this graph?
Yes.
I presume everybody can see the graph, right? So you can see two lines here. One is a horizontal line, which is basically your x-axis, which is your time as in years. You can see one more line here, which is your y-axis, which is your rupees, where basically that's your money. This dot here, or the 0 point here, is your first day in your job. Right? Now, what happens in your first day in a job? You start getting income, right? So when you start getting an income with increments, this line keeps growing, the income line, the green line keeps growing. And that happens over a period of time until you meet this point, which is one more black color line here. With this, you have one more line which is coming up, which is your expense line, which is your red line. So when you basically earn a rupee 100, you end up spending rupees 80. So then you start creating a cushion of 20. So the same thing happens. So as your life progresses, you get more money. When you get more money, you get more desires. When you get more desires, you spend a lot of money, right? So as the income line increases, you see even the expense line also increases, right? So this entire phenomena happens over a period of time till you reach the retirement. At retirement, what happens? At retirement, your income line unfortunately doesn't grow. It dips. You move from salaried income into a retirement kind of income. But unfortunately, for expenses, that doesn't happen. You're habituated to a certain kind of a lifestyle. You're used to travel in cars. You're used to going to nice restaurants. You like to buy nice clothes. So as inflation increases, this expense line post your retirement also increases. But at that point of time, after retirement, you're not earning so much in order to fund your expenses. So therefore, what happens? You're creating a deficit, right? So this is a very simple, it's not rocket science. What we need to do is very, very simple. We need to make sure this area here, which is your surplus area, is much greater than your deficit area. So once you've done that, you've done something really fantastic or really amazing, which is called as financial independence. How do we do that? How do we basically manage that? We manage that by three simple methods. One is your risk management. So we need to identify our risks and manage our risks. Second, tax optimization. How do we basically take more money home and reduce your taxes? Third, wealth creation. Let's chart out a plan and see what are our short-term goals, what are our long-term goals, and how do we achieve those goals over a period of time. Right? Any questions, any doubt?
Guys, do you have any questions as of now?
Clear so far.
Yes, Mr. Rakesh.
Yeah, clear so far. Makes sense.
Okay, great. Perfect. So please do stop me. As I said earlier, I don't want it to get a monologue and it becoming usually a 4:30 to a 6 o'clock kind of a webinar is a little boring webinar. So let me try to make it a little more interactive so that everybody understands what I'm trying to say, right? So since I've given you a small brief about what basically financial planning is, now let me get into the right-hand side of it. Let me talk to you about tax planning. Let me talk to you about risk management, and let me talk to you about wealth creation. Now let me talk to you about tax planning. Now, how tax works? Tax works is a very simple method. You get your income, that's your gross income. Then after that, all your reimbursements are taken, all your deductions are taken, then your investments are taken from it, then you're exempt, and then you get your taxable income. On your taxable income, you pay your taxes, and then you take back some home, money back home, right? Where does PeakAlpha basically come into the picture? Now, can PeakAlpha do something here, which is your gross income part? Nothing much other than I'll talk to your HR and your finance person and ask them to increase your gross income in order to increase your take-home pay, right? Where PeakAlpha comes is this part where your gross income moves to your taxable income, right? Now, I hope everybody has seen their salary slip. Now, your salary slip does have a lot of data into it. You've got your basic, you've got your PF, you've got your meal card, you've got HRA. There's a lot of things which are there in your salary slip, and it's important for you to understand what your salary slip says. Right now, in your salary slips, there are few components which are called as reimbursements. There are few components which are deductions. So those are the components where basically you get the tax advantage on, right? Now, if you see, I'll just come to the ATC. Now, once you study your salary slip, you need to understand what are your reimbursements. One of the bigger reimbursements, what you get is your LTA, which is called as leave travel allowance, right? Now, you need to understand what your LTA says and how many times in a year you can take an LTA. If you're a family, how do you basically utilize the LTA? Then you've got the HRA. All those are your other deductions which come through. So it's important for an individual to maintain or to keep all the receipts of the expenses what they foresee. Now, for example, your medical bills, for example, your rent receipts, for example, your travel expenditure. So all the receipts are important because once you declare that expenses to the company, and if they come under your reimbursements or deduction, you did get a tax advantage on it. This part here, which is your ATC, it is a very important part, right? Now, under your ATC, that's where you can actually make money. So what happens in ATC, there is something called as double benefit. Now, the first benefit you get is the tax benefit you get. But the second benefit you get is the investment you do in the instrument. Now, under Section 80C, there are a lot of subheadings. Now, for example, tuition fee for children, your insurance premium, what you pay, fixed deposits which are more than 5 years, your NPS, your ELSS saving schemes, what you invest into. So all these instruments are either bucketed into equity, debt, or no investments at all. For example, your ELSS or equity linked saving schemes are equity based. Your FDs are your debt based. And third part is your is a tuition fee for your children. Sorry, tuition fee for your children. That's basically there is no suddenly you can't see the returns right now, but hopefully when your children grow older, you can see a return in their education. Any doubts with ATC or any doubts with tax planning?
Mr. Majid, I have one question. So under ATC, according to you, what is the best way to go for? Like it should be ELSS or it should be other insurance, not insurance, insurance clubbed with investments options.
Unit.
Yeah. What should
Perfect.
be?
That's a very nice question, Mr. Rakesh. So every individual has got different kind of different kind of looking at investments. For example, you've got a lot of investments into shares, and if I look at your asset allocation, majority of asset allocation is skewed towards equity assets. Then it's good for you to invest into FDs, 5 years FD, or something which is debt oriented. Sorry. But if you've got no exposure towards equity, or you've got all your investment to FDs, then you can invest into ELSS kind of fund. If you don't have insurance cover, if you look at, I'll come towards insurance in the next tab, but if you don't have any insurance cover, that's one more segment what you can look at, right? So it depends on each individual and also depends on what kind of financial assets that person holds. I hope I've answered your question.
Okay. Yeah.
I'm sorry. Right. So once you've understood about your tax planning, let's move to the second part, which is called as risk management. So I've been in PeakAlpha for almost 15 years now, a little more than 15 years now. But this pandemic, the current scenario or current situation, what we are in, I have really felt that risk management is one of the most important things to take care of. I have lost a couple of my clients, and I have seen this part, which was the risk management, has made a big difference to them or to their family. So please do pay attention on it, and please do ask any questions you come up with, because risk management is a very, very vital part in your entire financial plan. Now, first, let's understand what basically is risk, right? Now, how do you evaluate your risk? Now, I want everybody here to do a mental math, right? Now, first is take your annual income today, multiply it by your remaining working years. Now, if you are 25 and you want to retire at the age of, say, 55, so multiply your annual income into 30. So you've got one big fat number, which is running into 10 digits or a 9 or 8 or 7 or 11 digit number, right? So feel happy about that number, because that number is going to help your children's education funding, help your children's marriage or your marriage funding, which will help you own a house, which will help you own your car, which will help you retire comfortably, and also to create a healthcare fund, right? So God forbid if that money is not available to you, all the risks, which is your children's education funding, the children's marriage funding, for your family to own a house, for your family to own a car, for your family to have a decent retirement income, everything goes down the drain. So that number, that we call it as asset value of life, or AVL, is a very, very important number. It's just not a number. That number is your family's dream. That number is a number which your family is going to fulfill all their dreams. So that number should be covered. Now, how do we do that? How do we basically break it up? So we basically break it up into 3 different components. Now, the first one, what you see on top, the circles, those are called as liabilities. So what are liabilities? Liabilities are basically the loans, what you've got. As I said earlier, during my first chart, which I showed you, as your salary increases, your expenses also increases. Now, one major factor in your expenses increasing is because you buy a car, you buy a home, you've got a lot of other personal expenses. So for that, you take up loans, and that loans are usually for a longer period of time. If you take a car loan, usually it's around 5 or 7 years. If you take a home loan, that goes up to 25 years, and so on and so forth. So that part, which is called as a liability, should be covered. Now, God forbid something happens to the earning member of the house, right? I don't know whether you've read the news. This was at least 6 years back. The financial institutions used to hire goons in order to recover money. So that's what you don't want your family to go through, or also your family to pay for the EMIs when you are not there. So that's the first thing you need to get yourself covered, right? First thing you need your family to get your liability cover completely insured. So that's your first enemy. That's something which you need to kill it. You either cover it or try to finish the loan as soon as possible. The second fund here is the one which is like a star or a odd shaped segment here, which is basically your non-negotiable goal. Now, what's a non-negotiable goal? Your children are going to a particular kind of a school. Just say that they are going to good schools, and God forbid something happens to you, then you don't want your children to stop dreaming about doing their PG or undergraduation in good prestigious college because of financial strain. Instead of that, you'll say, no problem, you just do a small course and go ahead with your life. That's a second thing. If you think that goal of yours is non-negotiable, that means that no matter what happens, you want your children to have optimum schooling, and for which you require insurance cover. For that, we call as a non-negotiable goal, right? So what do we basically do in a non-negotiable goal is, for example, if your child is, say, 3 years and he's got another 15 years to get into undergraduation and post-graduation, we see what is the cost of expenses he or she is going to incur when they reach 18 years old. So we take in a number as in today, and then we basically inflate it with a 10% or a certain percentage, depending how the inflation of education is growing, and then come up with a number. So that number is very important because that's a number he or she requires in order to have a decent post-graduation and undergraduation. The last part here is called as a family welfare fund. So, as I said earlier, your family is habituated to a certain kind of a lifestyle. You don't want your family to bring down their lifestyle if, God forbid, something happens to you. So in order to maintain that lifestyle, what we do is we look at your expenses over a period of time, from now till your spouse turns 90 or 95, till her or his end of time. We see what is the expenses your family will incur, and we try to get an insurance cover against it. Trust me, this exercise is very, very important. People do have a very negative notion about insurance because of how people in the market have played insurance to everybody. Like, for example, an endowment plan or some plan which actually doesn't make any financial sense. You really need to understand your need and cover it. And if God forbid, if there's any eventuality, your family should be completely secured with that kind of risk. Any questions, any doubts?
So, yeah, please go ahead and index it.
Yeah, so I thought somebody had a doubt.
No.
Okay, great.
Okay, so I have one question. So, so what is your best suggestion to cover this risk? Will it be a term cover sort of plan, or what should be the appropriate?
Yeah. So again, Mr. Rakesh, I'm really sorry if I'm repetitive, but again, it depends on a particular individual. But usually for funds like your, for covers like your liability, as well as your family welfare fund, the best way to do it is through a term insurance, because the term insurance is the most economical way to get an insurance cover. But if you look at a children's education plan, there is a possibility that you can take ULIPs, which are called as unit linked insurance plan. I don't know how many of you all know about ULIPs, but ULIPs are structured in a nice manner. They have a good, cover versus return kind of potential.
Okay.
Yeah. So can I go to the next section?
Yes.
Perfect. So once we have understood the tax planning part, once we have understood the risk management part, let's talk about something which everybody here wants to generate, right? Wealth. We all want to create a lot of wealth. If people didn't have the urge to create wealth, I wouldn't have been working here, right? So we help individuals also create wealth. Now, how do we do that? It's very simple. It's no rocket science. If you earn ₹100 and if your expenses are ₹80, the 20 is the surplus what you're going to generate. Now, what you can do with that 20, you can just go to a mall and spend all the 20, go to Zara or go to your best of the brands and splurge your money there, or you invest into jewelry, or you just put into savings account and don't do anything, where now it's around 1.5% or 2% is the interest what you earn, or invest into real estate, buy a house for yourself, or invest into properties, or just put into FDs. Unfortunately, FDs have gone a little lower now. Earlier, when I started, the returns on FDs used to be 10.5% to 11%. Now the FD rates are around 6.5% to 5.5% to 6%. Or invest into shares. But the main important question is where the investment should go, or what is the best way for you to invest, right? So for that, we need to understand what are the different asset classes, right? So there are 4 predominant asset classes. One is equity, debt, real estate, and commodities, like your gold and silver. is equity and what is debt? Equity and debt is basically financial assets. Financial assets is an investment which you do and which is not physical. You can't see it or can't hold it. Non-financial assets, on the other hand, is something what you can see and hold. Now, for example, real estate. You can see a real estate. You can stay there. You can get rentals from. And gold and silver is you can utilize it or you can just buy coins. Right? So let me just spend 2 minutes and try to explain to you what debt is and what equity is. Right? Now, just imagine here as a group, right? We have generated a corpus. We have generated a corpus of say around 1,000 crores. And we want to invest this 1,000 crores somewhere. We want to put that money for use. So we as a committee, we are sitting and thinking what we need to do. And suddenly we get a knock on the door and the finance minister walks in. And the finance minister walks in and says that, listen, I heard you've got 1,000 crores to invest. I want the 1,000 crores because I've got, I want to create a highway. And for that, I require this fund. And she comes and tells us, listen, what I can do is I can give you, say 7% interest for a period of 4 years on the 1,000 crore, what you're going to give me. Right? Now, we say, okay, fine, let me think about it. And then she walks out. And just imagine Azim Premji walks in and says that, listen, I want 1,000 crores because I want to give this amount to Wipro. And we've got a new setup coming in. I want to invest into that setup. So even he says, you give me this 1,000 crores and I'm going to give you back 7% interest on it and for a period of 4 years. Now, both the parties, one represents the government of India, the second represents corporate, right? So we as a committee need to decide whom do we give it to, because both of them want 1,000 crores at 7% interest rate for a period of 4 years. Now, as a committee, whom do we favor giving that amount to? Anybody from the group can answer that.
Equity.
No, whom do we give it to? Do we give it to the finance minister or we give it to Azim Premji?
Mr. Azim Premji.
You want to give it to Azim Premji? Reason?
Because the equity will multiply with times, probably with stock splits, dividends, incomes, and extra benefits they hold.
Good point, Mr. Rakesh. But here, what am I doing? I'm signing a contract with them, saying that they're just going to give me 7%. Both of them are going to give me 7%. They're not going to give me any part of their company. They're just going to take this money, take it as a loan, and give me 7%.
So would you decide based on how easy is it to recover the money in case one of them defaults?
That's a great point. That's a great point. That's exactly right. So I would tend to give it to the government of India because God forbid if something happens, they can just print money and they can give back the money to me, right? So the most safer option for me is to give it to the finance minister or give it to India. So that is the first step of debt. Debt is basically I can lend out money to somebody at a certain interest, right? Now, if Azim Premji needed my money, what he has to do? Anybody?
He should prove that he should provide some collateral, as in he can prove that in case he defaults, he can give some extra money.
Okay.
Like there's a way for us to recover the money.
That's a nice point. Or what he can do, he can also, instead of saving 7%,
higher rate.
9%.
Higher rate, yeah.
Higher rate. So what am I doing? I'm basically telling him is, okay, fine, I'm going to increase my risk. But because I'm increasing my risk, I also need to get better returns. Right? So that's how basically equity comes into picture. So what is equity? Equity, now then Azim Premji comes up and says, okay, fine, all right, listen, I don't want to discuss on the money and I don't want to give you a certain amount. Instead of that, I will give you a certain amount of shares. Now, once Azim Premji does that, what I'm going to do, I'm going to become a part of their profit and losses. My 1,000 crore can grow by 20-25% depending on how Wipro is going to perform, or my 1,000 crore is going to go down because Wipro didn't perform well or it went bust. So there is a risk and return kind of a ratio. So that's when the equity comes in the picture. So debt is usually safe, usually lesser in return. Equity is usually risk more and the returns are more high. Right? So if I've got shares of Wipro, say that I've got a couple of shares of Wipro, I can go to Wipro and say them, listen, I own this company because I own shares of Wipro. But I'm also a part of their profits and their losses. So that's a small tidbit about equity and debt. Any questions, anything which you all don't agree about?
I have a question.
Yeah.
So obviously, if you, let's say you want to invest in a certain company, like you want to buy their shares, that would involve a certain amount of understanding of the financial market on your side. And you obviously have to put in the effort to see how the company has been growing and to understand how the company is going to grow. Well, for a lot of people, it might seem like an unnecessary expense in time because they probably don't have the time or the resource to go into all of that and do that, right? And also there is this other aspect that, for example, if I buy 100 shares and maybe the profit is 10%, but the overall money that I want to get back is what, 1100 at the end of it. If I buy back the share, 1100. But if you actually invest a lot more initially, so you're going to get a lot more money because it's 10% of that. So in that sense, it's always a game of how much time or effort you want to spend or how much risk you want to take, right? So as a ballpark, like, is there anything a financial advisor would say, like, maybe you should not put more than this much percentage of your salary into something like that? Are there any benchmarks of that sort that will sort of help us to understand or start off with something like that? Yeah.
Thank you. So you basically explain what I do, right? So I do help individuals exactly what you explained right now.
Yeah, maybe you can do it for free for now for us.
I'll be more than happy. Right? So exactly what you said. People do invest, but important is where the investment should go get into, why they should be investing into it, how long they should invest. Right? As you rightly said, there are a lot of different shares which are there in the market. They are large cap, they are mid cap, they are multi cap, they are penny stocks. There are a lot of stocks which are there in the market. What suits you best? Right? Okay. Now, I'll just give you a small 2 minutes session about mutual funds. Right? How many of you all invest into mutual funds?
I don't.
Okay, all right. So I can't see anybody. So I think this question, I'm just going to say that people do understand a mutual fund, but whenever you're investing into equities, okay, you require three main things: time, access to information, and money. Number one, time. If I've got time, so if I say that if I sit on the trading terminal from the time it opens till the time it closes, I see how the entire market works. I keep moving my stocks accordingly. I've got time for it. Second, access to information. Access to information. I know all the companies' balance sheets, their profit and loss statements, everything in and out, all the stories about the company. Third, a lot of money. If I've got a lot of money, I can invest into various other segments. In mutual funds, a fund manager has got this three things by his job profile. Time, because that's his job. Access to information, because he's got a lot of funds sitting. They usually work with thousands of crores. So the CFOs of the companies come up and tell them, listen, I've got this project coming in. I think you should be investing into our company. So he gets a lot of details about it. Third, money. As I said earlier, everybody who invests into mutual fund, their money is invested in as a pool. So everybody here, if they invest, say, even as a lakh, we have how many participants? We are around 20. So 20, so we've got 20 lakh rupees sitting there for the fund manager to invest. So therefore, it's important that you've got these three things. If you've got these three things, you'll do fantastically well investing into direct equities. But if you slip in any of these three things, the safer way to invest is through the mutual funds. Nirikshit, I hope I've answered that question.
Yes, thanks.
So once you all have understood the financial assets, the non-financial assets is very simple. That's basically the real estate what you hold. That's basically any kind of properties or any kind of rental properties what you hold comes under the real estate segment. And then you've got commodities like your gold, your silver, right? So many of them invest into gold and silver. I know that there's one more asset class which is gained a lot of popularity, but I'm not going to dig into it, which are called as Bitcoins, right? So I don't want to get into the Bitcoins right now. It's a little muddier situation for me to talk about it. So I'll exempt talking about Bitcoins, but on a broader spectrum, equity, debt, real estate, and gold are the different sets of classes what you can be investing in. Now, if you tell me, Majid, which is the best thing for me, right? So this is basically the study over a period of time. Over a period of 25 years, what I've done, I've seen gold giving me a return of 5.7%. Bank FDs giving me a 10.3%. As I said earlier, when I started, which was 15 years back, FD rates used to be around 10.5%, 11%. Now it's dropped down to around 5.5% to 6%. But if I look at a 25-year period of time, I've averaged it around 10.3%. And BSE Sensex has grown fantastically well and is giving me around 15.6%. Now, for example, how many of you all know what inflation is? Anybody can answer what inflation is.
It's value of money to buy a particular thing or assets at real time.
Perfect. So that's what. So it's rise in prices, right? So that's what inflation is. Today my onions cost say around 15 rupees. After a couple of months, it goes up to 25, 30, depending on how the rains are, right? So there are a lot of things like that. The inflation keeps increasing. I'll give you a good example about inflation. Now, say that 25 years back, I had an option to buy so 25 years, what are the cars which were available in the market? I had a Fiat, I had an Ambassador, and Maruti was just coming into the picture, right? So say that I had a Fiat and an Ambassador at that point in time, and I would say, okay, fine, let me do one thing. I will stall the idea to invest, to buy an Ambassador. Instead of that, I will put my money into gold. And once after a couple of years, I'll take out my gold and buy an Ambassador. So because of a lot of my financial worries, I stalled the idea to buy a car. 25 years later, I go into the market to buy a car. But unfortunately, with the amount what I had invested in the gold, I couldn't buy the car today because the price of the car is increased more than my investment into gold. So therefore, I have become poorer by 1%. So my net real growth has become -1%. The same thing with FDs, my real growth becomes 3.6%. And the Sensex, my real growth becomes 8.9%. So what have I done here? I've put the inflation in the gold, the bank FDs, and the BSE Sensex to see the real growth of your investment. Any questions, any doubts? Perfect. So I'll take silence as a note of acceptance. So I'll go to the next slide. I don't know how many of you all follow the Sensex, right? But over a period of time, Sensex is a very interesting thing to notice. So this chart here is basically an investment from 1997, 1998 till now, this must be 2020 mid kind of investment, and the market prices were around 35,414. Today is close to around 56,000 levels, right? So in the entire chart, there is one part which is very interesting for me to look at, which is basically this part, right? This was basically in 2008 till 2011. So what happened during the part? Does anybody remember what happened between 2008? Something fundamental happened in 2008.
Recession.
Crisis all over the world, especially in USA.
Exactly. So that's the time where actually we saw blood bleeding in the market. That's where we saw people losing their jobs. And that's exactly 1 year before I joined the company. So I have seen the worst. And that's the time when you see in 2008, the market levels were a little more than 20,000 levels and goes down to 8,000 levels. And again comes back to 20,000 levels in 2011. If you look at the entire scenario, a person who felt that, the markets are going up, I don't know how many of you have seen news at that point of time. At that point of time, all the news channels were saying the markets are going to hit 50,000 levels. It's going to be a good bull ride. And then suddenly there was a collapse, right? So people who have invested in 2008 at 20,000 levels, if they have seen their growth, they would have seen a negative growth in their investment. If somebody would have invested here, he would have invested at a high market price. If he stayed invested till 2011, he would have not earned anything. He would have made 0 rupee gain. Is everybody in agreement? Yeah. But just imagine if somebody would have invested here in 2010 or 2009 at 8,000 levels, he would have made significant growth in 3-year period of time. So because somebody sold at this point of time because of fear, and somebody bought at this point of time because of greed, they have either made money or they have lost money. So whenever you're investing into markets, there are two kinds of feeling. One is fear, the other one is greed. So those both are two devils where you need to keep a control on whenever you are investing into the market. Right? Any question?
I have a question. So yeah, from the looks of at least how the trend looks like here. So if I invest, let's say 1,000 rupees today in the market somewhere, I can be more or less assured that in the long term, that is, I'm talking about something like 10 years or maybe 20 years, the returns on my money will be better than what inflation has brought down the value by. Is that a correct assumption?
That's
if I'm willing to wait long enough.
That's a perfect assumption. That's exactly what this chart was about. I'm looking at a 25-year period. If I would have looked at a 4-year period, that's from 2008, 2011, then this would not suffice well. So whenever you're investing into equity, the best way to mitigate that risk is by investing for a longer period of time.
Okay.
Right? Okay. So whenever you invest in the equity for a longer period of time, your money is a little safer. Now, if I draw a trend line from 1997 till 2021, if you see the trend line will grow like this. I don't know whether you can see my mouse.
Yeah.
You can see the pointer, right? So it keeps going like that. There might be a lot of fluctuations, but in the long term, it's a nice steady growth. people say if you are a young person in India, it's a boon right now because we are an emerging equity. Sorry, we are an emerging market. So you do invest whenever you're investing into emerging markets, it does well.
Okay.
Right?
Could you like is, for example, a country like Venezuela, some Zimbabwe, let's say at one point where they had extremely large inflation. So they in the long term, their markets would have actually gone down. Like, would you have seen that at a 20-year, over a 20-year period, they would have gone from 10,000 to something like 5,000? Is that what happened in those countries?
So basically, it also depends on countries, how it's been managed, and what are the basic resources from the company. So from the country, right? Now, unfortunately, places like that, they went through a lot of trouble, a lot of mishaps. So that creates a negative factor. But if I compare that to Indian market is totally different. But if I compare India to China market, that's a little different story altogether, right? So we've got lot of talent. We as Indians have got lot of perspectives are very, very good. We have seen the worst, but we have also come out with much better colors rather than being in a slump most of the time.
Okay, thanks.
Okay, so the next chart, it's time for my big secret, right? I want you all to keep, I want you all to really understand this. Right? So that's my secret. Buy low, sell high. Does anybody disagree with that?
No.
What is the catch? Why do you think buy low, sell high is pretty simple, but does anybody know what the catch is?
Because nobody knows.
How do you determine it?
Highest of the peaks or high of the peaks, or it's the bottom of the trend.
Yeah, exactly. I'm sorry, Ms. Pooja, I couldn't hear that well.
I just said how you determine when is low, when is high.
Perfect. Great. Perfect, Ms. Rakesh, and perfect, Pooja. So exactly, you don't know when the price is low. You don't know when the price is high. Now, how do we do that? How do we basically manage that, right? So for that, let's call back the club which we had earlier, where we created 1,000 crore club, right? So let's get that club and let's work with an investment club again. But here we are going to follow some ground rules. Now, the ground rules are, I'm going to come up with the asset allocation. Now, the asset allocation would be 50% in equities and 50% in FDs. Now, for equities, let's put it into shares, and for debt, we'll put it into FDs, right? Then every quarter, we reset. Whatever's more, we sell. Whatever's less, we buy. Simple. Is everybody in agreement with this? A thumbs up also would do well.
But with every quarter, does FD interest changes that much?
Yeah. So basically, if my equity increases and goes to a certain level, I will sell. Say that it's become from 50%, my equity is grown to 60%. I will sell that 60% and bring it back into FDs and make it back into 50-50.
Okay.
Okay. So I'll give you an example. So as a club, we're going to do it. So say that as a club, we have got 20 lakh rupees, right? So we just want to test the water. So we got 20 lakhs. So in July, we've got 20 lakhs and we put that money into investments. Now from July and October, there was a good growth. The bull market was pretty strong. Your 10 lakh became 15.5 lakh, right? And your debt at a normal segment grew at 5%, and then your 10 lakh became 10.5 lakhs. correct? Now, in total, how much my 20 lakhs has become right now?
26.
My 20 lakhs has become 26 lakhs, right? Now, what did I tell you? Now we have met the first quarter. Now, what did I tell you? What am I supposed to do to make it back to 2020 or make it back to 50-50?
So I have to pull 2.5 lakhs from the equity and invest into debt.
Perfect, Mr. Rakesh. So that's what I'm going to do. I'm going to take out 2.5 lakhs from equity and put it into debt. So I'm again getting back to the 50-50. So therefore, I've got 13 lakhs in equity and 13 lakhs in debt. Now, unfortunately, the next quarter wasn't a good quarter for the bear market. Yeah, Niresh.
So what do you mean by debt? I'm sorry, I missed.
So debt is basically, just imagine you put your money into FDs, or fixed deposits.
Why do you call that debt?
Oh, that's a very interesting question, right? So debt is, there are two ways to look at debt. Now, one is debt. People usually call that the loan what you carry is called as debt. But here, you are a loan giver. When you're giving money to the FD, when you're putting your money in FD, you're basically giving the loan to the bank.
Yes.
At a certain rate, right? So therefore, that gets considered under the debt market or debt part of your portfolio.
Okay, fine. So in some sense, then equity is also similar to that. You're giving the company to, you're giving your money to a company, right? They're going to use it for something.
Exactly. And remember my Azim Premji and Nirmala Sitaram story?
Okay, fine. Okay. So
right?
here
So
you're
it works on the same basis.
Okay. And probably the return is fixed in case of debt. Like the bank tells you that I'm going to give you this much, whatever happens. Okay.
No matter what happens, even the market goes down, there's a commitment that bank is supposed to pay you, it pays you.
Okay.
Perfect. So in October, we've reset it. We've got 13 lakhs each. It's a good story. My 20 lakhs has become 26 lakhs. I'm an happy investor, but unfortunately, the bear market hits us in March, right? So what happens in bear market? Bear market is basically the time when the markets correct themselves or they go down or they become negative. So your 13 lakhs becomes 10.5 lakhs. But as I was just talking to Nirekshan, your 13 lakhs in a debt fund slightly goes up and becomes 13.5 lakhs. So again, my 26 lakhs is become how much now?
24.
24 lakhs.
24. Yeah.
So again, going by the principle, going by the the game plan, what am I supposed to do?
So pull 1.5 lakh from debt and invest into 1.5 lakhs in equity.
Exactly, that's what I'm going to do. So then at the end of March or end of May, what's going to be my final outcome? That's around 24 lakhs. So I invested 20 lakhs. I followed a system, and in the end, I've got 24 lakhs in my bank. Right? So what we did, we followed simple. We followed something called as sell high, buy low. Right? Is it easy to do?
Yeah, if you have 20 lakhs initially, maybe it is. Most of us don't. So
no problem. Everybody starts with a small amount. Over a period of time, we get much more than 20 lakhs.
Okay, makes sense.
Right? So that's simple. That's exactly what we do. We help individuals maintain their asset allocation. We invest into equity-oriented and debt-oriented schemes. We make the investments in a way such that we monitor the portfolio. We tell them when to come out of equity and put it into debt, how much you should be doing that. So there's a lot of things which work behind in order to keep your portfolio in a much sturdy manner. So discipline is a very important factor whenever you are investing, right? So next is one of my favorite slides. So let me tell you a small story, and this is about two individuals. One is Nikhil, the other one is Nihal, right? So Nikhil and Nihal basically studied together, and when they were 21 years, they met and they said, "Listen, let's do one thing. Let's start investing." Nikhil said, "Okay, fine. I'm going to invest from 21 to 30, right? That's what I'm going to invest for 10 years. I'm going to put 2,000 rupees per month into a scheme which gives me 13% return. And after that, I'm not going to do anything. So for 10 years, I'm going to put 2,000 rupees per month." So how much has Nikhil invested? So Nikhil is invested around 2.4 lakhs, right? On the other hand, Nihal, like most of us, he says that I just started earning. Let me enjoy my life now. Once the responsibilities hit me, that's when I'll start investing, right? So at 31, he says that I'll start investing for 30 years. So he starts investing when he's 31 years till the age of 60. He does the 2,000 rupees per month. So he's invested around 7.2 lakhs. Any questions?
No.
Okay. So at the age of 60 in some retirement park, these guys were taking a walk, and suddenly Nikhil and Nihal said, "Hey, remember when we were 21 years, we had come up with a pact. Let's see what happened with the money," right? So Nihal was very happy. He said, "You just invested 2.4 lakhs, but I have invested 7.2 lakhs. So my 7.2 lakhs has become 88 lakhs, right? So that's pretty good, right?" Nikhil had a very nice grin on his face, and he said, "My 2.4 lakhs is become 2.4 crore. Anybody can give me any reasoning why that happened?"
Compounding.
Because, yeah.
Yes, because of power of compounding. Correct? So what happened was Nikhil's first 2,000 rupees had 40 years for it to grow. And its last 2,000 rupees had 30 years to grow.
Correct.
On the other hand, for Nihal, his first 2,000 rupees had only around 30 years to grow, but his last 2,000 rupees didn't have any time for it to grow. So therefore, this part, we call it as the ninth wonder, right? Power of compounding is very, very important. That's why we always urge people, it's not the amount, it's a time when you start investing. So you start early, start disciplined investment. In the end, you end up being very, very happy because you have a pretty decent retirement life. Right? So any questions with any part of my presentation?
I have two questions.
Perfect.
So the first one is, for example, let's say you have a very large corpus of money, some X lakhs or whatever. So many banks, if you put that X lakh as a fixed deposit, you can technically get the interest can be paid to you every month rather than being accumulated in the FD itself, right?
Yep. Yep.
So that would mean that you are technically using the money. You might use it for your expenses or to live or whatever, but then the corpus remains the same. Let's say I keep doing that for 10 years, so I can use the expenses, the interest for my expenses for 10 years, but at the end of those 10 years, I'm going to get back the exact same amount of money. However, due to inflation, that amount of money has now lesser value, right? So probably if I invested X, it's now become 0.8X or whatever due to investment. So at least from what you explained, it looks prudent that I would always not want to take out the interest, leave it back in the FD so that it will compound it this way. Is that correct?
That's a good point. That's a good point what you've put across. So, as I said earlier, investments are for a long tenure. It is not for a short tenure, right? Now, you have an income. Just now, you spoke about a person who has reached his retirement. If
Okay.
a person has reached his retirement and doesn't have any income, then he can start getting pension income. We call it pension income or retirement income from the interest what it generates. Right?
Okay.
Over a period of time, so whenever you see your your life cycle, you've got a phase which is called as earning phase, another phase which is called as a retirement phase, right? So that, remember my first chart, so the surplus part and the deficit part. So the theory what you just now said works well once you retire and there is no excess cash flow coming in. But for a longer period of time, it's always good to have an asset allocation. Have exposure to equity, have exposure to debt. Looking into your risk appetite, put your funds into equity-oriented funds, or also have an exposure to debt in order to take care of any market and eventualities.
Okay. I have one last question.
Sure, sure.
So the other aspects that's clear from this is that, for example, if I, let's say, save some amount of money for, let's say, 5 years, okay, and I manage to, let's say, save 3 lakh rupees in 5 years without having any risk. I just save it in a RD or in a debt. Then I take all this entire 5 lakhs and invest in equity, or like how Nikhil has done in this particular case. So that might actually give me a lot more money at the end of 30 years compared to if I keep investing the same 5,000 rupees every month till 30 years. That is what is apparent from this chart that you have drawn.
Yeah, so I would little differ from that, right? Now, instead of accumulating the money in FDs, you do the investments in equity, right? So thinking that your exposure towards equity is less, right? Now, once you start investing into equities, if you're invested for 5 years period of time, it's a long tenure. It's in equity, it's a good tenure to be invested. So you are investing also when the markets are lower. But if you're going to take out the FDs after 5 years and going to invest as a lump sum in the 5th year, then what's going to happen? You're going to enter the market at a higher price. Instead of that, you're investing on a periodic manner, you're averaging out the costs. So therefore, your potential, that we call it as the multiplier, the multiplier becomes less.
Okay. Thanks.
Ms. Parinita, I think you had your hand up.
Yeah, I had that, but then you answered my question, what I was about to ask. So
I'm happy I did so. Okay.
Yeah, thank you.
No problem. Perfect. So anybody else?
I have one question.
Yes, Ms. Rakesh.
So suppose you have 1 lakh rupees at hand and you want to invest in equity. So is there a magic percentage or formula that one needs to follow to invest in, like, systematically, not investing as a lump sum, but at certain percentage with, like, in every quarter or every 6 months or every month, like that? So is there a certain percentage that help us in long term?
Okay, now if I understand your question correct, you're saying that if you've got a certain amount and you get an option of investing that into equity, is it good for you to invest in a staggered manner or put it upfront? Is that question correct?
Yes.
Okay.
And is there any certain percentage that one should follow?
Yeah. So first of all, whenever you are investing, as I said earlier, your asset allocation is important. How much is into equity? How much is into debt? Once we have understood that, then we will take whatever excess amount what you've got and see how much of that amount. So for example, if your portfolio is say around 50 lakhs and you want to invest 50,000, I would put it over a period of time and stagger it over a period of time. So what we call it in our financial lingo, we call it as a systematic transfer plan. we park it into a debt fund, and from a debt fund, it gets into an equity on a staggered manner. So that's your step number one. So we usually do it over a period of 6 months period of time. But if we see the markets correcting drastically, then we inject more from the debt into the equity market. So it's not a percentage of equity and debt really differs from individual to individual. I have also had customers who were in their late 40s, had more risk appetite to come to youngsters who didn't have a lot of risk appetite. They wanted to keep the money safe. So therefore, first is for you to understand why you're investing into an equity and debt, what are your goals, and then come up with a ratio, how much should be in equity and how much should be in debt. I hope I've answered your question, Rakesh.
Yes. Got it. Yes. Got it.
So any other questions?
I have one.
Sure.
So is it correct to assume that in a growing economy or a growing market, the returns from a bank would always or in general be able to cover the inflation? Is that a correct assumption?
It's a very interesting assumption. Yes, till a point. That's
Okay.
what happens. You're usually the bank FD is a little higher than the inflation, right?
Okay.
But once your economy is growing, now let's take an example of Japan and US. In US, if you get a 1% on interest, you're way too happy. You've made good money, right?
Oh.
Because the markets have already matured. It's a good market to be in. If you look at Japan, it's even one more further step. If you keep your funds in FDs, you need to pay money to them.
Okay.
So so once the economy grows, your debt returns in that economy is way too less. Why? Because your economy becomes so strong that your default risk is very less. Again, go back to Sitaram and Azim Premji case. It works on the same principle. The risk return. A person investing into India market from outside India would, as compared to a US, the money is more safer in US compared to in India.
Okay. Thanks.
I have one question.
Sure.
Yeah. So if we want to have have low risk appetite, so does liquid mutual funds offer as a better option than FDs?
That depends on a couple of things. Now, that depends on the time horizon when you want to invest into. Now, if you invest into FDs, you need to pay tax on the interest what you incur, correct?
Yes.
Even if you don't take out your money, correct? But in a liquid fund or a debt fund, unless you don't take out your money, you don't need to pay your tax. When you take out your money, you either pay a short-term capital gain or you pay a long-term capital gain. If a short-term capital gain in debt fund is basically any investment, if you liquidate before 3 years, you pay short-term capital gains. That is linked to what the taxation you pay on FDs. If you stay invested for more than 3 years, if you stay invested more than 3 years, then the long-term capital gains works out much better, because in that it's only 20% after indexation. So the blanket answer for your question is the debt funds are much better than FDs. There's a lot of flexibility which is there.
Okay.
Any other questions? Okay. So the next steps, so I'll just talk to you about how you can interact with us. So we as a company, we have moved into a segment. We help individuals manage their cash flows. We handhold them during the period of time. The good news, I think it's Nirikshit or Rakesh, I'm not really sure. Somebody said is if you can do that free for me, I'm happy to look into it. Yes, we do it for free. We don't charge anything for the advice what we give. So we board you onto something called as NSE platform. From the NSE platform, we help you doing your transactions, and then we put you into different buckets regarding how much of AUM what you have hold with us. And but in a nutshell, we don't charge anything for the advice what we give, but we handhold you with the advice, and we also help you executing that advice. Right. So, so you can reach out to us. So this is our this is where you can reach out to us. That's one of my colleagues' email ID, which is suganti.suresh@peakalpha.com. You can write it to her, or you can call up on the Bangalore office, or even Abhishek has got my contact number, so you can reach out to him. I'll also drop in my contact number on the Zoom page, so that you can reach out to me at any point. So I have, yeah, Panita, you had a question?
Yeah, sorry, there was some issue with my mic, so I couldn't ask earlier. I just have one more question. What would be your suggestion for crisis management? For example, if an investment goes wrong, so what are the steps one can take to address that problem?
Okay. Yeah, that's a very, very important question, right? So we believe in the system saying that don't put all your eggs in one basket. So for that, the simple answer is diversification. You need to diversify your investment. You invest into, say, 7-8 different kind of mutual funds. Even if one mutual fund is not performing well, you can rely on other mutual funds giving you better return. Number one. Second is understand where you're investing into. Don't invest into something which is not being regulated. Don't invest into something which is, I'm sorry if you all been investing into it, but like your chit funds or funds which are not being regulated. So invest into something which is regulated. Invest into something which you know or has got a pre-record, have got historic data to evaluate and say that these funds are doing well. So whenever we choose products, we see products which qualify these kind of segments.
Okay, so all in all, real estate sounds like it would always give a good return, but many a times that doesn't happen. So will this rule apply for that also?
So real estate is a very different animal. So real estate is a time where, so what I usually tell my clients is when you invest into real estate, you need to have one property for yourself where you reside. Maximum have one more property where you get your rentals for, right?
Okay.
So whenever you do your entire portfolio, you look at your portfolio, you look at your financial assets, you look at your non-financial assets. Let not your properties go more than 60% of your complete financial assets, complete assets, rather, right? So again, there goes your diversification. One more negative thing about real estate is at the time of need, you don't get liquidity. You buy a property and you'll say that, okay, after 5 years, I'll sell this property and I will educate my son or use it for the marriage funding. But unfortunately, you cannot do that because you're not getting a buyer. And real estate is an industry where a seller is usually, being downplayed.
Yeah.
Right? So therefore, important is diversification. Important is you've got investments into different kind of asset classes so that you're not dependent on a particular asset class in order to fund your emergencies.
Okay.
Hope I've answered your question.
Yeah. Thank you. Thank you so much.
Nirshit, you've got a question?
No, I press it.
So that's all from my end. Thank you. I hope I've tried my level best to answer your questions and try to impart a little bit of knowledge what I've got regarding investments. I have shared my number on the chat. You can reach out to me at any point of time. Any kind of questions, if you want to get, if you want to start your services through us or anything on that front, you can reach out to me, or you can take the number from Abhishek, and I'll be more than happy to help.
Oh, thank you very much, Majid. That was an excellent presentation, I would say. And you definitely clarified a lot of doubts we had in terms of what is a debt, what is an equity, the power of compounding, and the importance of diversifying the portfolio, the investment portfolio. Why should we do that and all those? And I saw some lovely questions, I think, come from Nirikshit, from Rakesh, from Parinita. So overall, I think it was a good session, and I would request all the attendees to please also reach out to me if you need, any further need in terms of coordinating with Majid or with Suganti. And Majid, I will share all these participants' email ID to you, and you can reach out to them. And if any of you would like to interact with Majid on one-to-one basis, please feel free to share your number and have a direct interaction with him. Thanks a lot again, Majid, for the session.
Thanks a lot. Thanks a lot for the warm words.
Thank you.
And, I'm sorry?
Thank you.
Thank you. Thanks a lot.
Thank you.
Thank you.
Bye-bye.
Bye.